Let's take a look at this basic variance analysis problem. Becton Labs produces various chemical compounds for industrial use. One compound, called Fludex, is prepared using an elaborate distilling process. The company has developed standard cost for 1 unit of Fludex as follows. And then you see in the table here, we start off with direct materials, 2.5 ounces, $20 per ounce for a $50 standard cost. Direct material takes 1.4 hours to make 1 unit of Fludex. Costs $12.50 per hour. So that comes out to be $17.50. We're just multiplying across. And then variable manufacturing overhead, they've determined already to be $3.50 per hour, and it takes 1.4 hours. So that comes out to be $4.90, giving us total standard cost of $72.40. Okay, during November, the following activity was recorded relative to the production of Fludex. Materials purchased were 12,000 ounces at a cost of $225,000. There was no beginning inventory of materials. However, at the end of the month, 2,500 ounces of material remained in ending inventory. Okay, that was A and B. Now C says, and I'll move my mouse out of the way, the company employs 35 lab technicians to work on the production of Fludex. During November, they worked an average of 160 hours at an average rate of $12 per hour. D says variable manufacturing overhead is assigned to Fludex on the basis of direct labor hours. Variable manufacturing overhead cost during November totaled $18,200. And during November, 3,750 good units of Fludex were produced. The company's management is anxious to determine the efficiency of the Fludex production. So on requirement 1, for direct materials, we need to compute the price and quantity variances. Okay, so now on the screen you see the solution, and we'll walk back to the numbers if we need to, or we'll look back to them. In the solution here, the materials price variance is computed on the entire amount of materials purchased, but the materials quantity variance is based only on the amount of materials used in production. So we've got a difference. Okay, now I like using the 3-column approach that you see in the solutions here, and I think of it this way. The left side is always actual quantity times actual price, and the right side is always standard quantity times standard price. So we were told there was 225,000 of actual quantity for materials, and let's take a look at that again. Okay, so material purchased was 225,000, of which there was 12,000 ounces. So that's where that came from. Okay, the other thing I want to take a look at is during November they said 3,750 good units of Fludex were produced, and we know the direct material cost, or the direct material standard, is $20 per ounce. So looking over here, we go to the standard now and we say 9,375 ounces were produced. And how did we come up with that? They had 3,750 units times 250 ounces per unit. That's what was called for in the standard. So 9,375 ounces of this material represents the standard quantity allowed for output. So we take the 9,375 times that $20 standard price, and we come up with 187,500. Now to find the middle ground, we move over the actual quantity, and we knew that was 12,000. Typically it's laid in here, so we'd have 12,000 times whatever that rate is. Now they didn't give us that, and we actually don't need it. We take 12,000 ounces and move that over. Then the $20 we move over, and we're able to compute this middle territory, which is actual quantity times the standard price. So if you want to do it in this column approach, you can do it that way. And you say 12,000 ounces times $20 per ounce was equal to 240,000. So the actual quantity input times the standard price would have been 240,000. We compare that with the 225,000 that we actually paid for, right? We actually purchased, and we've got a 15,000 favorable variance. Okay? Then when we go to compute the material variance, or excuse me, the quantity variance for material, we don't consider what we purchased, we considered what we used in production, right? So what we have to use is a comparison of the now 9,500 ounces times the $20 per ounce versus the 9,375 ounces at $20 per ounce. Okay, now one question you may have is, why do we only have 95 ounces here? Why are we only using 9,500 ounces? And let's take a look at the problem again. Okay, we purchased 12,000 ounces, but there was no beginning in inventory, and 2,500 were available at the end. So 12,000 minus 2,500 at the end means we must have used 9,500 in production. Okay, so now we take that 9,500 ounces, that's the standard, that's the actual quantity we used, and we compare it to the 9,375 ounces that the standard called for. We multiply both times $20, so we're comparing 190,000 in this middle ground, which represents actual quantity at the standard price versus the standard quantity at the standard price. And when we compare the 190 to the 187, since the 190 is higher than the 187, the difference represents an unfavorable quantity variance. Okay, now you could also compute these more directly if you don't like using the column approach by saying the material price variance is equal to the actual quantity times the actual price times the standard price, right? So the actual quantity was 12,000 ounces, and we compare 1875 minus $20, and when we do that math, we come up with 15,000 favorable variance. If we take the 225,000 of what we paid for the material and divide it by the 12,000 ounces we purchased, we can compute the cost per ounce, which is 1875, and that's where that 1875 comes from. Okay. Then on the material quantity variance, we take the standard price, which is $20, times the differences in the quantity. We already said that 9,500 ounces were used. The standard called for 9,375. So when we multiply 20 times the difference between 9,500 ounces and 9,375 ounces, we come up with that 2,500 unfavorable quantity variance, which of course matched that right there. Okay, now I've put requirement B down in this little box here. And requirement B says the materials were purchased from a new supplier who is anxious to enter into a long-term purchase contract. Would you recommend the company sign the contract? Let's take a look at the solution so we can answer that. Okay, here's the solution again. And what we see is that we had a 15,000 favorable variance on a basis of 225,000 in purchases, and we had a relatively small unfavorable quantity variance. So if we think these two variances are related, or actually based on the information we have, this looks like a good deal for the company, right? If it's costing us $2,500 for whatever reason in excess usage of the material, we're still saving $15,000 in the price variance. Now this of course assumes the new supplier is lower than the old supplier, and the old supplier was built into the standard. So the conclusion here is the price variance is pretty large relative to the relatively small quantity variance. So this looks like a good deal for this company to enter into this arrangement.